Hello and welcome to a new episode of 160 English. So today we are going to discuss about how you can identify the non-genuine or fraud financial advisories. It need not be the financial advisories there on the YouTube or any of the social medias, but many people they seek advice from professional advisory services also, financial advisories, investment advisory services. Many people individually as well as companies institutional wise they are running investment advisory services, and they are charging for that also. Most probably they will charge you quarterly, or sometimes that will be in an accumulated form of annually. Now the question is how you can select your investment advisory, because all these investment advisory firms or individually also they claims that the performance is at least at par or above the expectation of any investor. In short, they always claim a higher alpha. When the market performs at 5% or market returns are 5%, they claim that their returns is 50%. So blindly majority of the investors they trust them and they seek advice from them. They registered for the services. Among them, we can find a lot of fake coins are there. Sometimes the advices that you are taking maybe from online social media also, there also you can find some fake coins. Need not be everything correct. Now the topic of the discussion is a few points if you can consider. You can avoid these kind of fake coins. You can select the right advisory. The first thing you have to keep it in mind is none of the advisories or the recommendations need not be 100% correct, or it won't succeed 100%. If someone claims that all our recommendations or all our calls was successful in the past, that means either they must be God or he should be a great liar. Only two people can make the equity or any of these capital market recommendations correct. Either he must be a god or he must be a great liar. So never ever believe anyone who claims his recommendations hit the target 100% of the time. You please avoid that kind of people. Second type of people is some people they run their own business. For example, some people they run their brokerage business. In that case, their primary motive is to divert your entire money to a certain field, maybe to the trading arena, because the brokerage that we get from trading, that's much higher than that you as an investor. That kind of people always try to convince you that trading is a better arena. Always you have to go for it. I am not against trading, but trading is suitable for some people, investment is suitable for another type of people. Mainly depends on the investment or investment goals. But if someone is running their brokerage business, they always try to convince you that trading is the only best solution for you to amass great money. So keep away from those kind of advisories or people also. Other type of people is they may be very much familiar in the online space. Online space doesn't mean that that's a YouTube or Instagram. There may be sometimes they shown their face in some of the television channels also. So never trust the people just because of the fact that they have shown their face in the television channels. I don't want to say that all the people they came in any of the business channel and gave some comments they are bad. Not like that. But as a service seeker, you should not give much weightage to the people who have shown their face on the television channels. That's the only thing, because many people they have a feeling that someone has shown their face in the television channels or in the printed media, those people are trustworthy. No such things are there. Nowadays we know that everything is business. Even media also, if you can give a few lakhs, they will publish your articles, they will publish your autobiography, they will conduct an interview and so on. So nothing great about someone shown their face in the internet or any of the social media or the printed media or anything like that, conducted an interview. no credibility. So don't give much weightage on that factor. The fourth factor you have to take into consideration is their experience in the financial advisory field, especially if someone is primarily giving capital investment advices. Make sure that he has gone through a complete bear cycle. If he could able to survive in a bear cycle, then he can guide you well. So some people they have just started their capital market career in 2018. That time, no such a bear market, you can say. Only a drastic dip that happened for a small period of time during the COVID. They might have amassed some money during this period. Unfortunately, in a longer period of time, they are not competent or matured enough to give advice to other people. So avoid that kind of people also. Make sure that at least the advisory firm or the individual is there in the market for at least 5 to 10 years. The fifth type of people you should avoid is avoid the advisors who promise you assured returns. None can promise you assured returns, especially if you are investing in capital markets. He can assure you a guaranteed return if and only if you are investing your entire money in either bonds or in FDs. But just to invest in bonds or FDs, most probably none of you will go for a investment advisory. So whenever you are being exposed to the capital markets, especially to stock markets or commodity or whatever it is, there is nothing called assured return. So if some advisory give you a guarantee about assured returns, that means he is not trustworthy. Avoid such kind of people. Sixth point you have to take into consideration is make sure that the advisory firm is there for a longer years, that we have already told. But make sure that their claims are correct. At least you can check that particular company is there for a few years as they have claimed. You can go to at least Ministry of Company Affairs and check the company registration details. So nowadays everything is go online, make a website and claim so and so. So anyone can do that. So make sure that their claims are correct. You have to do research on them. Let the advisory firms make research to get a better investment returns. But before you start, you do a research on the advisory firms, because when your selection goes wrong, it's not that you lose your advisory consultation fee, but you may sometimes lose your entire capital that you have invested by receiving wrong advices. The last point I just want to give you is you please ask the investment advisory that in which way they are generating their recommendations. I have seen a lot of investment advisors, especially they are giving advices to their clients on equity or commodity or in other sort of mutual funds or anything by using automated indicators, automated softwares. So okay, that's good, nothing bad about it. But unfortunately, that majority of the time that will not meet the requirements of the clients. When you pay money to an investment advisor, what we are expected is there should be a manual curation of investment advice should happen. For example, when an investment advisor gets an input from an automated analytics software, he should think about that particular indicator outcome before he delivers that to his client. He should think whether that particular advice will suit as per his client's needs. So that's all for now. Take informed and right decision before you select any investment advisors, so that you can protect your capital as well as you can get better returns. That's all for now. See you in the next episode. Till then, bye from Anup.